Hello, it's Jeremy Whaley here, and I've got another video for you where I want to talk about account allocation. Now, account allocation is maybe not the first thing that you woke up this morning thinking, oh, I want to talk about that today, but we're going to talk about it because it's an important thing. And I've titled this one, How to Best Allocate Your Trading Account. Now, when we think about account allocation, there's multiple levels we can talk about this. On a kind of a general basis, when we think about what is account allocation, it's just simply how we diversify an account. And this can apply to anything from your individual trading account to your overall retirement account to your overall financial well-being. It really applies to everything. It's just how we divide it out. And the reason we do allocation is as a function of risk management. You've heard it said probably you don't want to put all your eggs in one basket. Put all your eggs in one basket, what happens? Well, you might be fine, or maybe the basket gets a hole in the bottom of it and all the eggs fall out and they go splat. So, all your eggs in one basket's maybe not a great idea. Same thing with your financial planning, your financial world. So it's a function of risk management. That's why we want to allocate things across various assets. And finally, what it does is it helps us to stabilize your overall account. If we're thinking about, an individual account, helps to stabilize that. Or if we're thinking about, broad financial planning, then it helps to stabilize your overall financial well-being. So this is what account allocation is. Now, let's get into it. All right. So for starters, I'm going to kind of talk about three different components of this. One is the big, what I call the grand 40,000 foot overview scale. This is broad financial planning. Big picture. And then we're going to kind of zoom in to what I call the 10,000 foot overview. And this is going to be basically all your paper assets, your stocks, your IRAs, 401ks, all that stuff. That's going to be kind of like the 10,000 foot overview. And then we'll go micro into your trading account. And we'll talk about how all these pieces fit together, okay? So there's a lot to get through, so let's go relatively quickly here so we can try to be done in less than 10 hours. No, I'm just kidding. This is not going to be a 10-hour video. Quick disclaimer, though, I am not a financial planner, and this is not specific investment advice. I'm definitely not a certified financial planner. The concepts I want to present here are for educational purposes. And basically what you want to do is you want to take these concepts, you want to kind of mull them over in your head, think about how they might be practical for you, how you might apply it in your own personal financial world. And then you can take these ideas to your financial planner and say, hey, I want help implementing X. I want help implementing this. And that's the best way to approach the information that I'm sharing with you. All right, so let's start with the big 40,000 foot overview. This is what I call broad financial planning. Broad financial planning. I know, I just said I'm not a financial planner, right? Listen, the truth is I'm not really qualified to talk about this, but I have some key ideas that I want to share, and that's really all we're going to talk about for this particular subject. This is going to be everything from real estate to stocks to estate planning and wills and all of that stuff. So like I said, this isn't really my wheelhouse in terms of what I teach. Normally I focus in on just the stocks and options and how those things work. But there's a key concept here that I want to share with you. My broad perspective, my general perspective of financial planning, I've put it together in a training that I call Building or Designing Your Financial Fortress. And that's actually available on my personal website, jeremywhaley.com. So I'm going to share some of that concept with you here momentarily. And it's broad overview in terms of concept, but it really emphasizes what I consider the most important thing for your big picture, and that is income. Income is king. You want to create as much income as possible, and then you want to diversify from there. So we want to focus on creating as many little engines of income as we possibly can. Some other key concepts, life insurance is really quite valuable. So you want to make sure that you've got yourself covered for life insurance. And I don't just mean like, hey, when you die, your family gets some money. Actually, life insurance is one of the best financial planning tools that's available. There's some really unique products available, and if you don't have a good plan with your life insurance, you need to consider doing that. I actually do have a couple financial planners, one in particular who I consider a super uber expert on life insurance, and he blows my mind with some of the stuff that he comes up with life insurance. So if you don't have those pieces in place, it's not just about insuring in the event that you die. That's part of it, but it's a really valuable tool for passing wealth on, part of your estate planning and whatnot. So keep that in mind. And then, of course, think about taxes. This is an area that a lot of financial planners really fall short on. They don't really think about the tax implications of everything. So Those are kind of my big four things here. Focus on building a financial fortress, which we're going to talk about in just a moment. Make sure you focus on building income. Make sure you don't forget life insurance, and plan for your taxes. Those are my four big 40,000 foot overview concepts. All right, well, let me dig into this financial fortress concept really fast. I'm going to do this all in one slide, and I'm actually going to make this big so you can see it. The idea of a financial fortress is all about diversification. Everything in this concept is about diversification. What you're going to notice is you're going to notice across the bottom here, just take this idea that's kind of like Greek Parthenon. And across the bottom, you have what I call the foundation. Across the top is what I call extraordinary living. And in the middle is what I call cash flow columns. Now, cash flow columns hit that aspect of income. Cash flow is king. Income is king. You've got to have as much income as possible. This is how you're going to build wealth. This is how the wealthiest 1% do it. And so the idea, if you come back to the model here, the idea is to have some real estate, have some trading, have your job for a while. Maybe eventually you get rid of that, but you still have your job, you have your businesses, you have your other income. And if any of these were to disappear, then your financial world does not disappear on you, but rather one of these other cash flow columns will support you and sustain you. That is the idea of the financial fortress. Now, like I say, I have an entire 6-hour training on this concept. But I just wanted to hit on a very high level. This is my big 40,000 foot overview idea of how I personally like to see financial planning implemented on that grand scale. If you want to learn more about it, then you can go to jeremywhaley.com and you can learn more about building and designing your financial fortress. All right, that's the 40,000 foot overview. Let's talk about the 10,000 foot overview as we kind of narrow this down. And this is specifically going to be the area of paper assets. What are paper assets? Paper assets are going to be things like your IRAs, your 401ks, your trading accounts. If you work for a nonprofit, maybe it's a 403b. It's all of the paper that is considered retirement usually. I'm lumping two things together here. One is the retirement accounts, such as what you get from an employer. And the other are your trading accounts, such as your TradeStation account, your Thinkorswim or Schwab or whoever it is that you're trading with. And you might have several of those accounts, okay? So this is kind of on that scale. It's just one piece of your overall big picture. And then within each of these, if you're talking about your IRA, if you're talking about your 401k, if you're talking about your trading account, within each of these, you're going to need to have additional allocation and separation as well. We're going to talk about that right now, okay? So a question that I get from a lot of people is, how much should I trade? Out of this entire, retirement that I have, how much should I go out into the market and actually trade? And of course, since that's what I primarily focus on at Trade Maestro, it's a natural question. And the answer is, it depends. It depends. That's always the answer, right? It just depends. Probably about 10 to 15, maybe 20% of your overall retirement funds. And I'm not lumping into that your house. I'm not putting into that retirement funds, real estate investments and some diversification at the 40,000 foot level. I'm specifically saying if you have $100,000 that you have saved in an IRA, 401k, whatever, your savings account, and that's your paper assets, that's what I'm talking about. Out of that, maybe take 10, 15, 20% and use that for active trading. Outside of that, everything else is kind of more big picture that you need to deal with. So the big question, when I say how much, it depends. The big question is, how much do you have? That is really the number one question. How much do you have that you can actually work with? If you have $100,000, then maybe your trading account should look like $10,000. If you have $1 million, maybe your trading account looks like, maybe you start off with a $50,000 trading account and you work up to maybe $100,000. If you're starting off with $10,000 total, if that's your entire retirement, well, honestly, you might need to trade all of it just so that you have a chance to actually get caught up. Because frankly, if you have $10,000 at IRA, 401k levels, you're not ever gonna get caught up. I mean, these little Peasley 5% a year stuff, that's not going to work. So if you have like 10 grand or something, you're probably going to have to, it may look like 80 to 100% that you put in your trading account. So it really depends on an individual basis, and you're going to have to just kind of look at your own financial world and say, How much can I justify putting over here into active trades? Another question you have to consider is how good are you? How good are you? Some people, they pick up their trading very quickly. Other people kind of struggle through it. And if you're on the kind of struggle through it end of it, then, maybe you need to not be trying to do as much. And for those of you who are really, gifted at it and you pick it up very easily, maybe maybe you beef it up a little bit. Maybe it's 25%, maybe it's 40%. It just really depends on how comfortable you are, how much money you have overall to work with, and how much it's going to affect your big picture. I will say this, generally speaking, a $10,000 to $20,000 starter trading account, that's a pretty decent size. Frankly, $5,000 while you're learning to trade is a decent amount. 10 to 20,000 is an amount that you can turn 20,000 into 150,000 in a couple years. Honestly, I've done it. That's not the hardest thing in the world to do, and so 10, 20,000 I think is something that's reasonable to work with. Starting with 1,000, yeah, you can get there eventually, but that's a long road to hoe. So I think the 10 to 20,000 is a really good, decent account size to start with when you're starting out your trading. Now, I will say this. A lot of people think, well, I don't have 10 grand, so I can't start trading. Start learning so that when you are ready, then the money can appear. Or said differently, when the money appears, then you're ready. And that's maybe one of the biggest things that I run into with people is they say, well, I just don't have the money, so why should I learn to trade? And I say, because you don't have the money probably because it hasn't been a focus for you. But if you were focused on learning to trade, you realized how much you could make with your trading. Now you've proven it with fake virtual funds. Suddenly it becomes really easy to go find the real money to actually go fund your trading account with 10 grand, because 10 grand is just not that much money, generally speaking. All right, so that answers that question of how much should we trade. Now let's work with, what do I do with the rest of it? So I got a 401k, or I got a 403b, IRA, whatever it is that you have, and you're trying to figure out, well, if I'm only supposed to trade maybe 10 or 15, 20% of it, what do I do with the rest of it? So the first question is that you got to go back to that 40,000 foot overview. What kind of income do you have? What various sources of income? Because, it might be you need to pull some of that out and put it into real estate. It might be you need to pull some of that out and maybe diversify across a couple income sources. And that's a different conversation. But, get your 40,000 foot income cash flow columns working, and then we start to kind of narrow down within each of these. So first question is, what's the 40,000 foot look like? And then once we got that under control, assuming the big picture's in place, and we need to go put some money to work. How are we going to do that? So here's how I think about it. And what I'm specifically going to talk about right now is inside your IRA, inside your 401k, your retirement account. How do we want to place that money? This is separate from your active trading account. Okay, I really want to clarify that, because your active trading is one style, one phase. That's going to be really aggressive stuff. Your retirement account, you don't want to be as aggressive, but we still want it to grow. So how do we do that? Well, you have to understand 93% of fund managers don't have the ability to match the S&P 500. I mean, that's ridiculous. I mean, it's really ridiculous, and it's frankly, it's a sad state of where we are in terms of our financial system. I mean, it's just SPIVA is the group that puts out a study every year. It's called the SPIVA study. You can Google that. In fact, I'll try to remember to put a link below the video here. But the SPIVA study is something they update every year, and I've been tracking it for maybe 8 or 10 years now. These numbers, they stay within like 2 or 3% margin of error. So off the top of my head, here's what the numbers look like. Over a 1 year period of time, it's something like 70+ % of fund managers do not match their S&P benchmarks. Okay, so that means on a given year, you need to have a fund manager who's in the top 30%. Okay, that's not too bad. That's not too hard. Most people can find somebody like that. Go over a 3-year period of time, and you'd think it would get better, but no, it doesn't get better. Over a 3-year period of time, it's in the 80%, like 84%, 86% of fund managers cannot match their S&P benchmarks over 3 years. You're like, wow, it should be going the other way. You'd think that the professionals would be better than an index. Turns out they're not. You go out to 5 years, and it's in the 90s. It depends on which benchmark you're looking at, but I think it's the S&P 500 to the large cap benchmark is like 94% of fund managers cannot match the S&P 500. Small cap, I think, is around 95%, which it just gets worse and worse the further you go. You go out 15 years and it gets even worse. It's crazy. What that tells us is if you want to hire a professional fund manager to manage your funds, you got to have a 1%er. You got to get a top 1% fund manager to manage your funds. Well, guess what? With all due respect, unless you're in the top 1% of society, you probably don't have enough money to really attract a top 1% fund manager. Because most of the top 1% fund managers are working for really big firms, they're managing hedge funds, or they're doing something along those lines. You know, your typical Edward Jones or Wells Fargo advisor, they're just not going to cut it. And I'm sorry, it's nothing against Edward Jones, nothing against Wells Fargo or any of these people. They're just not, generally speaking, that great of fund managers. They don't match, much less beat the S&P 500. So how do we do it? Well, I have found a product that is great for this aspect specifically. And it's a company called Market Gauge. And I met these people at a seminar that we were part of. It was a trade show, actually. And I just love, first of all, I love their philosophy and I love their product. It is for this purpose right here. So if you've got an IRA, a 401k, if you have some retirement money you need to place that is separate from your active trading, it'd be great if you could just hand it over to a fund manager and they would do it. Problem is they're not going to do it. The skill level there is just not there. So how do you do it? Market Gauge is the answer. What Market Gauge does, Keith Schneider, the guy who designed this system, he designed it for hedge funds. And then they turned around and offered it to retail traders like yourself. For less money than you would pay a fund manager, you can buy their models. So, if you're paying 2% or even 1.5% a year for $100,000, that's $1,500 a year. You're paying someone to manage your money and they're doing a bad job with it. The money's just going to fees. You can get Market Gauge's models for less than that. And then you manage it yourself, but you follow their models. So what it does is it says, move your money now. And then you move your money. Then it says, move your money now. And then you go move their money. And it works. It just works. It's got a 10-year track record. It's just absolutely fantastic. And that's it. So this isn't a sales pitch for Market Gauge. This is really just how I would think about managing a 401k cash that's not part of active trading. I would follow the Market Gauge models to a T. In fact, I'm doing this. I do this for some money that I manage for my parents, and I do it with my own stuff as well. So I really am a big fan of this for that style of stuff. Now, this is stuff that you're going to move maybe 5 times a year. It's not big moves. But this is, big picture and consistent growth. Only move the money when the model says to move the money. Now, really fast, I'm going to kind of explain it because there's some allocation that needs to happen here. There are 4 models within Market Gauge now. There used to be 3, there's 4 now. The big one, the one that is my favorite, is what they call alpha rotation. And I would take out of your account, out of your available retirement trading, I would take maybe half of that and put it in alpha rotation. And what this is really simple. It's just risk on, risk off. And this model has never had a losing year in like 11 years. It's never. And in all but maybe 1 or 2 of those years, it's beat the S&P, and it's beat it by a long shot. I mean, it's a stunning model. And I have no idea how they do it. It's amazing. And it's just really simple. Move your money to S&P, to SPY, move your money to cash, or move your money to treasuries. And it just tells you, hey, do this right now. And then you go follow the model. And if you do that, you're going to make money with it. It's amazing. The second piece I would do is maybe 25 to 35% in their model that they call the NASDAQ All-Stars. And what it does is it's going to put you in 5 stocks. And they're going to be the top performers of the NASDAQ for right then, based on their model. And then the other piece, they have a new model called their small cap model. Now, this has just been released, and I don't have a lot of track record on this one yet. I would either put maybe 15 to 25% in their small cap model, or they have another one that's their ETF model. And what this does is it diversifies you across 9 ETFs. Those three pieces right there, alpha rotation, NASDAQ, and either the small cap or the ETFs, gives your retirement money fantastic diversification. And it's going to grow in the 15 to 20, 25, maybe even 30% or more a year range. And that's for your, we'll call that your big retirement money. That's a great way to handle that money. Now, I'm not saying you have to do that. It's just a great way to handle it. Then you see the little red piece of my pie. That's what's left. That's your 10 to 15, maybe 20% for active trading. That's what you're going to go manage. That's where you're going to go do the option trades where you make 100%. That's where you're going to go, be selling the cover calls, doing the active stuff where you might be making 50, 80, 100% a week. But you don't want to do that kind of trading with your overall retirement. You want to do that with a sliver of it. Okay, now there's another way we could look at this. This is an equally valuable diversification model. So let me share this one with you. Still taking the same tools, basically. We're going to do maybe 40% in the alpha rotation, 25% in NASDAQ, 15% in either small cap or the ETFs, 10 to 15, maybe 20% in your active trading. Okay, so I'm sticking with that number, but I'm moving about 10% over to currency. And I'm specifically thinking, when I talk about currency, I'm really talking about cryptocurrency. Okay, international fiat currency, maybe not as much as maybe we used to, but now that we've got crypto, now that we have Bitcoin, and it's not just Bitcoin, we got Ethereum, we have Ripple, we've got, all these cryptocurrencies. You need to start thinking about that. If you've not thought about crypto, if it's been like on the fringes for you, you need to start thinking about it. And I'm not talking about buy the ETF that, holds Bitcoin. I'm talking about buy Bitcoin. Because you got to think about this not as an investment. See, that's how most people think about crypto. Most people think about crypto as an investment. Hey, I'm going to buy some crypto and I hope it shoots to the moon. I hope I buy this one for a nickel and it becomes the next Bitcoin and it's 50,000. It's not how you think about it. You got to look at it and say, if I'm thinking about this as a currency trade, if I'm thinking about this as instead of holding US dollars, I'm going to hold Bitcoin, I'm going to hold Ethereum, or I'm going to hold a basket of crypto. You're looking at the overall basket of crypto as it moves against the US dollar. For people that are international, if you're international, you're going to understand this. They think like this. For Americans, we don't think like that. Americans do not think about what's my currency doing. My wife is from Brazil, and her mom, who is not an investor, who doesn't really understand this stuff at all, frankly, she couldn't do any of the stuff that we talk about and teach at Trade Maestro. She understands this concept. It's crazy. Like for my wife's whole career, her life, not her career, but her life, her mom would always keep US dollars in Brazil. And then whenever they needed to make a big purchase, they would wait until the US dollar was really strong, and then they would trade it for the Brazilian real, and they would have like so much more buying power. Because they understood, growing up in a borderline third world country, they understood that their currency was always being devalued against the US dollar. For Americans, since the US dollar is the world reserve currency, we don't realize how much it's being devalued, but it is, and it's being devalued bigly. And the only ways that you can offset that is to either buy gold, buy silver, or now we can buy crypto. So it's not just inflation, it's devaluation of currency. And the problem with gold and silver is they're being artificially suppressed. So I'm a fan of gold and silver. I hold physical silver. I have found that to be the easiest way to get into that, and I'm a big fan of that. But the reason crypto is valuable is because it's an offset to the not just inflationary aspect of the currency, but the devaluation. And so that's why it's worth considering. We're not going to go into great detail on that right now, but I wanted to put it out there because as you're thinking about account allocation, this is a really, really valuable way to think about it. Okay. Now that brings us to the third and final piece, which is your individual trading account. And what is this? This is your active trading account. This is the money that you want to go put into the options. This is the money that we're like, hey, we're going to go big on this. We're trying to really grow this. And it needs to be maybe 10, 15, 20% of your overall paper assets. These are going to be your short-term trades, day trades, swing trades, option trades, all that stuff. That's what your trading account is. And like I say, it probably needs to be about 10 to 20% of your overall paper assets. So how do I diversify the trading account? Now that we've got to this very narrow thing, how do I diversify that? Again, it depends. Well, here's the thing. Once you've done everything else, this piece becomes really, really simple. And here's my rules for it. Manage a handful of trades. That's the first rule that I have. Don't try to go out there and manage 100 trades. It's ridiculous. Manage a handful of trades, probably 4 to 12. 4 to 12. I've kind of, been making a note of what I tend to have. And at any given time, I tend to have on the low end 3 or 4 trades open, and on the high end around 12 trades. That's what I have found. I'm not saying I never get higher. Sometimes I might. I'm not saying I never get lower. Certainly there's times I just go to cash. But on average, I tend to have somewhere between 4 and 12 trades active at a given time. And for me, I'm an options trader. That's where all my money is. I do have some positions in there that are a little bit longer term. I don't think it really matters. If you've done the rest of the allocation like we've just talked about, then this piece is really just about how aggressive can I be with 10, 15, 20% of my account. That's really what it's about. And that's what you want. And by the way, when you have this kind of allocation, if you have a bad trade, you're not freaking out that you just lost your retirement. Where people mess up is they lose their whole retirement because they don't allocate. And so this is really important to give you the psychological freedom that it's okay to go make money with a short-term trade and to lose money with short-term trade. I mean, in both cases, there's a psychological freedom, and account allocation will help you achieve that freedom. So first of all, 4 to 12 trades. Next, limit your trade drawdown to 5% or less of your overall trading account. What do I mean by drawdown? If you've heard me talk about this, it's the difference in your entry price and your exit price. Difference in your entry and your exit. So if you enter your trade at, say, $100 and $100 per share, and let's say your exit, your stop might be at $93. So that's $7 per share. Say you did 100 shares, $700. That would be your account drawdown. $700 cannot be more than 5% of your overall account. So the difference between your entry and your exit price, whatever that is, you can't risk more than 5% of your account on that little piece right there. Now, if you diversify over, 5, 10, 15 trades, 4 to 12, as I put here, and you manage to a 5% drawdown or less, you're not going to go broke. Those two levers right there. The only other thing is to, just make sure you have some winning trades. But those two pieces right there, you won't go break. And then here's the third piece. The third piece is your risk-reward ratio. You need to make at least $2 for every dollar you risk. So, on item number 2, where I talk about the difference of your entry and your stop, or where you exit, if that's $1 a share that you're taking there, your profit, the entry to your target, needs to be $2. So you're getting $2 for every dollar you put at risk. And when you manage to that, guess what? You only have to win about 40% of your trades, and you're making a fortune. These numbers are boring. I get it. These numbers are boring. This isn't the exciting part of trading. This isn't where we're buying a call option for $10 and we're selling it for $40. This isn't that part. This is the nitty-gritty of account risk management, allocation. And this is the stuff that will keep you in the game. If you do this right here, this screen right here, diversify over, 4 to 12 trades, limit your per trade drawdown to 5%, 2 to 1 reward to risk ratio. If you do this part right here, you'll never go broke. You'll never go broke. And then if you do that in the context of everything else we've just talked about, the 40,000-foot financial fortress, the individual retirement accounts, you have some diversification over into some market gauge models. And if you don't use market gauge, that's fine. I really don't care. I don't have a dog in this fight. But you're not going to get a great fund manager probably. And if you have that great fund manager, then wonderful. Use them. Give them 90% of your cash. Take the other 10%, and you go manage it yourself and be an active trader. However you choose to do it. If you've got all those pieces in place and then you follow this, you're not blowing up trading accounts, and you're going to be making a ton of money because you're managing the risk to reward and you're doing it appropriately. These pieces right here, this is what will keep you in the game. This is what will absolutely not just get rid of that volatility going up and down of your accounts, but it will show the consistent, steady growth. And then you'll start to realize what a valuable piece the active trading is. If you're one of these people that goes out and you try to trade your entire account and you're putting it in options, you're going to be miserable. And it's foolish. I would never tell anybody to do that. It's foolish. So don't do that. Okay? Follow these rules right here. Now, people say, well, what should I trade? What should I trade? Well, you're going to hate this answer. The answer is anything. The truth is anything, folks. If it's in the stock market and there's a trading opportunity, you can take it. I mean, really, it doesn't matter. It's not like there's rules around, oh, you don't want to trade this, you don't want to trade that. Other people say, well, you need to diversify. You need to have a little bit of tech and a little bit of this, a little bit of that. You know what? That doesn't matter. It really doesn't matter. The people that are saying that are the same people who can't beat the S&P. So I teach in my pick winning stocks training and other places. I teach a very simple strategy to beat the S&P every year. Every fund manager in the world should take a look at that course and figure the strategy out, because it's really simple. There's no excuse to not match or beat the S&P 500. There's zero excuse. And yet people do it. Most fund managers, they do it being they can't match it or beat it. So, when you say, what do I trade? Don't go look at those people that can't beat the S&P and follow their account allocation. They're all over the place and they're not getting good results. I say trade anything you want to trade. If tech is doing great, if you like trading Tesla, go trade Tesla. If you like trading Apple, go trade Apple. If you like trading the FANG stocks, go trade the FANG stocks. That's 5 stocks right there. Use all the other techniques that I teach and do all the other diversification we talk about, and you're not going to go broke. You're fine. So it doesn't matter about diversifying over sectors and all that stuff. You don't have to worry about that. You say, well, where do I start? I would say start with my Trade Maestro top 25. That's a great place to start. It's 25 great stocks that meet a certain criteria, great volume. They got great volatility. It's got all the stuff that you need to have some great trades. It's almost any given week, you can find at least 3 or 4 trades on the top 25 that are good trades to go take. That's a great place to start right there. Outside of that, look for good volatility. You want stocks that go up and down 30, 40, 50% on a typical swing. That's what you want, because that's where you're going to make your money. You need stocks that have good volume. I say at least, a couple million shares, 1 to 2 million shares minimum of average daily volume. So if your average daily volume is 100,000 shares, it's not worth messing with those kind of stocks. They're not bad. They just go for the big boys. Go for the ones that have good liquidity, that have really good volume on them. And then if you're an options trader, which I am, you need an optionable stock, obviously. So it needs to be optionable. And I look for a minimum open interest of at-the-money options of 500 plus. Okay. That's what I want to look for. If it gets down to there's 100 open interest for your options, then I'm probably not going to trade that. I try to go 500 plus. The more, the merrier. You look at something like SPY, you're going to have tens of thousands of open interest. You look at something like Alaska Airlines, you might have a couple hundred. So you just kind of think about those things. And the reason open interest is important is because it talks about liquidity and how easy it is to get in and out of the trade. So those are important numbers. Now, if you don't know anything about options, then what I just said is Greek to you. Take some of my options training. But if you know what I'm talking about, if you're an options trader, you totally understand what I'm talking about. And those are the numbers that I look for, okay? So finally, let's talk about what not to do. What do I not do with my trading account? Glad you asked. And here's what we're going to say. First of all, you do not trade your entire life savings with no diversification. Don't do it. That is one of the most foolish things you can possibly do. And I've had it happen. I had a guy, won't mention his name, but I had a guy, he had a trading account of about $400,000, and it was his entire life savings. Outside of the house he lived in, that was it. And he started trading options with it. Now, I told him not to do it. I told him not to do it. I told him not to do it over and over and over again. And he just kept whittling that thing down over and over. I had a girl that came to me one time. She had almost $1 million, like $800,000. And it was their money. It was really her husband's retirement account. And without him knowing, she decided to start trading it. And she went and she started buying out of the money call options on Apple. And before she knew it, she had lost most of her account. And then she came to me So I didn't even get to teach her. Like somebody else, she found this like on the internet somewhere, just like on a web forum or something, that said, hey, you should buy calls in Apple. And she went and put everything in there thinking she was going to go make, 10 times her money and, have $8 million. Instead, she lost all their retirement account. It was horrible. And so, people do it. You might think it's crazy, but there's a lot of people that do this, and they come to me after the fact. So, we're trying to put Humpty back together again. So just don't do it. Don't trade your entire life savings. Don't put everything into one trade. Now, I'm going to say this. If you have done this, if you've traded your life savings and you've lost it, if you've put everything into one trade and you've lost it, there is life after misery. Trust me, there is. So, pick yourself up and, let's learn to trade. Let's go learn how to do this. But if you're on the other side of it and you haven't done that yet, don't do it. Protect yourself, diversify, and do the account allocations like we've talked about in this video. Do not put everything into treasuries. Not that there's anything wrong with it. It's just that you're not going to make any money. And treasuries do not keep up with inflation. They say they do, but they don't. They do not offset the devaluation of your currency. Don't put all your money in treasuries. You're not going to ever get anywhere. So if you want to stop that feeling that, I'm always a little bit behind, I never quite get caught up, do not be putting everything in treasuries. Now, there's a place for treasuries at certain times. But generally speaking, don't put everything in treasuries. And most importantly, folks, don't be afraid. Don't be afraid. This is the number one thing I deal with. You got to try to uproot all those fears because people are so afraid of losing everything. If you do the account allocation like I've talked about in this video, and this is rock solid, even though I'm not a financial planner, I'm telling you, if you do this type of account allocation, there's a lot of tweaks you're going to have to make for you. You're going to have to look at that 40,000 foot overview, figure out what income sources you can build. You have to look at that big picture, life insurance and estate planning and all that stuff. You're going to have to look at that probably with a financial planner. Then you look at your retirement accounts. And if they're not performing the way you want, if you don't have a top 1% fund manager managing your accounts, then consider the market gauge models. I'm telling you, these are really, really good models. I will put a link below so that you can actually link over to those and decide if that's the right fit for you. It's a really good thing for that retirement piece. And then you come into your trading account. And with all those other pieces in place, all that pressure to perform and to be perfect with your trading account, I don't want to say disappears, but it relaxes so much. And now you can actually be a trader. And you can make some, big profits on pieces of your overall. And then you can take some of that money, you can reallocate it. You can go buy another cash flow column, you buy some real estate, buy some more income, and you just keep going right back through the 40,000, 10,000 trading account, 40,000, 10,000 trading account, and all of it starts to work together. It's just a beautiful thing. It's just a thing of beauty. Money doesn't have to be hard, folks. Investments do not have to be hard. We just weren't taught it in school. And since we weren't taught it in school, everybody's out there just trying to figure it out on their own. So I hope this has been really helpful for you. I want to remind you, this is not specific investment advice. I'm not telling you to go specifically by this, specifically by that. I am giving you some pretty good guide rails for how you want to think about your account allocation. And if you do this, then I think you'll be really, really pleased with where you end up on the other side. Hey, thanks for watching. I hope you got a lot out of this video, and I hope you get a lot out of all of my videos. I hope you're watching all of them. But before we move on, I want to invite you personally to join the Pick Winning Stocks Challenge. This is a fantastic challenge that I've put together. It's 21 days. It'll change your trading career. How's it going to do that? Well, first of all, I'm going to teach you how to pick the direction of the trade. So you always know which trade direction the stock is going. Is it going up? Is it going down? Is it going to go sideways? I'll teach you how to figure that out. I'm also going to show you exactly how to apply the right strategy at the right time, and then I'm going to turn around and show you exactly how to manage your risk as well as how to write your trading plan, the absolutely perfect trading plan. I'm going to show you all this stuff. I'm going to teach you how to choose a stock. Some stocks are good to trade, some stocks are not. I'm going to show you how to do all that. In other words, it's everything that you need so you can pick a winning stock. And isn't that the outcome? Isn't that the whole purpose of coming to the stock market, so that you can learn how to pick a winning stock, so you can buy it and you can sell it and make a profit? That's kind of the idea, right? This is a 21-day challenge. That means 21 days from right now. 21 days. That's 3 weeks. That's it. Just 3 weeks. 3 weeks from right now, you can have all these questions and a whole lot more answered in the 21-day Pick Winning Stocks Challenge. All you need to do is click the link below, get yourself enrolled, get yourself signed up, and get started immediately. For most of you, this is the next step on your journey. So go ahead, get yourself signed up for the Pick Winning Stocks Challenge. I know you're going to absolutely love it. And as always, if you want to learn some more, all you need to do, get yourself subscribed, subscribe to my channel, follow me on social media, follow me on Facebook, Twitter, wherever it is that you want to try to follow me. Just follow me there, and even just go to my website at trademaestro.com. Click below the links right here. We got the links to the website, got some links to other resources, all great stuff, lots and lots of cool stuff out there. So go check it all out, and I look forward to sharing it with you. And until next time, happy trading.